Thank you, Jyoti. All the distinguished members on the dais, starting with Mr. Sethi, the Chairman of the State Bank of India, Chairman of the IBA, Mr. Atul Goyal, the CEO of the IBA, Mr. Agrawal, FICCI President, Ms. Jyoti Vij, DG of FICCI, and Mr. Ruchir Goyal, BCG, who made a very insightful presentation on the banking sector as it stands today. Good morning to all of you. It gives me immense pleasure to be in the middle of the leading lights, the captains of the industry, especially from the banking and the financial sector. It's brought together all of you, thought leaders, various stakeholders, and I'm sure that this conference, which is the second edition by IBA and FICCI together, will be deliberating on some of the very contemporary and critical issues facing the Indian economy and especially the financial sector. The topic of this conference, again, is very, very topical and very relevant, charting the new frontiers as we stand at a very critical juncture amidst challenges from geopolitical tensions and tariffs and so on and so forth. I'm sure that the discussions will be very fruitful and useful for the industry, for the government, and for the regulators, and it will provide us a way ahead. It will provide us with some very good guidance and suggestions on the way to move forward, especially at a time when we are looking forward to achieving our vision of Viksit Bharat. And so I compliment the IBA and the FICCI for taking this lead and organizing this conference. We celebrated our 79th Independence Day 10 days ago. We have made huge progress since our independence across sectors of education, health, rural, urban development, electricity, power, finance, governance, defense, science and technology, so on and so forth. The Indian economy also has expanded manifold. It continues to be a symbol of resilience and hope. The achievements of the Indian economy, despite unprecedented challenges in the last few years, are undoubtedly very creditable and widely recognized. The Indian economy today is characterized by robust macroeconomic fundamentals. The Indian economy rebounded post-COVID. We recorded 8% per annum, almost 8% per annum growth CAGR in the last 4 years. The IMF projects that we'll again be one of the fastest major economies in the world. And we are all set and projected to be the third largest economy in the coming years. The inflation at the same time, over the last decade, especially after the inflation targeting framework was introduced, has been very benign. It's much lower than what it used to be earlier at about 4.9% per annum. This July, we had the lowest inflation at 1.6% headline for the last 8 years. The Indian government's fiscal position is also very strong and robust, having decreased its fiscal deficit now from 9.2% post-COVID and projected to go down now to 4.4% this year. This is not, at the cost of quality expenditure. The capex, as you are all aware, has been growing, and now it is projected. This year, it is budgeted at 4.3% of GDP. This, of course, includes grants in aid to the states. And similarly, the corporate balance sheets are very healthy. Mr. Sethi pointed out at the robust and healthy balance sheets of the banks, whether it is profitability, solvency, liquidity, and asset quality. My compliments to the industry, especially banking sector, for this stupendous performance and this turnaround over the last decade. India's external sector, again, I need not speak more about it. It has been very comfortable. The current account deficit over the last few years has been well within the sustainable limits. Last year, it was only 0.6% of GDP. And of course, this is because of strong exports in services and very healthy inward remittances, for which India today actually has the record of being highest recipient. We have very robust foreign exchange reserves, $695 billion US dollars, as per the latest figures that are available. With us, sufficient to cover 11 months of merchandise exports. This has been all possible because of the very strong and prudent fiscal and monetary policies followed by the government and the various regulators over the last few years, structural reforms, massive upscaling of both physical and digital infrastructure, improved governance, and enhanced productivity and competitiveness. We are now at a critical juncture, as noted by some of my earlier speakers, as we navigate the choppy global economic environment characterized by heightened trade uncertainty and persisting geopolitical tensions. We need to push the frontiers of growth. We all must step up our efforts to address the emerging challenges and at the same time seize the opportunities that are coming our way. Generations of freedom fighters gave us free India, a Swatantra Bharat. We need to now work for a Samridh Bharat, a prosperous India. In this backdrop, I thought it appropriate to speak on what we collectively need to do to further build on this economic development in our country. I have divided my thoughts into 5 major areas: monetary policy and regulation, and 3 relating to the banking industry. Mr. Sethi has made my task a little easier by mentioning them upfront, so I'm thankful for him, for having already acknowledged that we need to improve further financial inclusion, customer service, and technology. Again, something which even the BCG report talks about and emphasizes. The role of monetary policy, first of all, monetary policy. The role of monetary policy in economic prosperity is critical. One of the major conduits of macroeconomic stability in India during the recent years, despite many shocks, has been the decline of inflation, as I noted even earlier. Sharp spikes in food prices, volatile oil prices, global supply chain disruptions, and geopolitical tensions could have significantly stoked inflation. However, proactive policy measures by both Reserve Bank of India on its part and supply-side measures by government have helped contain the generalization of price pressures. Anchored inflation expectations too have supported stable consumption patterns and improved investor confidence. The primary objective of monetary policy in terms of price stability has significantly contributed to the strength of India's macroeconomic fundamentals. At the same time, the Reserve Bank has not lost sight of its objective of growth. For example, before COVID, when growth was slowing, and even in recent months, when inflation has been benign and growth needed to be supported, the Monetary Policy Committee reduced the policy repo rate. And so we will continue to conduct monetary policy with the primary objective of price stability, keeping in view the objective of growth. Coming to regulation of banks and NBFCs, they still continue to occupy a very, very major portion of our credit needs. 73% of the total credit needs in our country, they are satisfied, met by the entities which are regulated by the Reserve Bank of India, including the banks. The banks contribute about 53%, remaining 20% coming in from the NBFCs, the HFCs, the All India financial institutions, and others. This shows the importance of the RBI regulated entities in meeting the credit needs of the economy, and it has been our endeavor to regulate these entities with an aim to ensure that the financial system remains healthy and grows sustainability. Regulation, I would like to mention over here, is that it's akin to friction. If friction is too less, which some people will demand, one will fall while walking. And if it is too much, on the other hand, it will certainly impede progress. Regulations provide the necessary friction to promote financial stability and safety of depositors' hard-earned money. However, stringent regulations may impede growth of the economy. The art of regulation making lies in finding the right balance between safety and growth, the right amount of friction, in other words. Pursuit of this balance or optimal regulation has always been our constant endeavor in the RBI. And so we have followed now 5 principles in our regulation making. You are all aware of these 5 principles. I will not go into the details of those principles. First of them is that we have now moved more towards principle-based regulations rather than being prescriptive or rule-based. We have espoused the idea of proportionality to strike a balance between the costs and benefits of regulation. Impact analysis, I may mention here, is an integral part as to how it's going to impact each and every regulated entity, be it small or big. We have been consultative in our approach. We do various outreach programs. We have started the Connect to Regulate platform through which we reach out to all our stakeholders and the general public seeking suggestions on our regulations. Fourth, we have attempted to be evidence-based, data-driven as far as possible. We gather a lot of information. I think there has been a feeling that there is a lot of information seeking that is happening now from the RBI, but information is important for decision making, and I would request all the regulated entities to kindly assist us and provide us this information as quickly as possible in our endeavor to improve our regulation making. Fifth, we have been agile. We have adapted with change in context. We have course corrected with availability of new information and evolving landscape. And we have not hesitated in relaxing a stringent rule once deemed necessary if the context changes and the cost-benefit balance reverses. What we do as a matter of practice has now been institutionalized. As all of you are aware, recently we had issued the framework for regulation making, which codifies this approach, including these 5 principles that I mentioned. Even this year, we have taken out a number of regulations: urban cooperative banks, risk weights to NBFCs, the provisioning requirements for government-guaranteed security receipts, priority sector lending guidelines were revised to boost credit to the undeserved segments. We have rationalized the runoff factors for the LCR. It will hopefully release liquidity of about 6 percentage points. Similarly, we have come out with comprehensive and rationalized regulatory framework for investments in alternative investment funds, co-lending, non-bank, non-fund-based facilities, project finance, and gold loans. All these are examples of how we have been agile, we have been consultative, evidence-oriented, principle-based, and proportional in our regulation making. Going forward, We will continue with this approach. Our focus will be threefold. First and foremost, we will continue strengthening financial stability. This is our primary objective. This is the foundation on which this whole system is built. And so we do intend to implement the Basel III guidelines for market. They're already the draft is already there. Similarly, credit and operational risk from 1st April 2027, for which credit risk and ECL-related draft guidelines are now proposed to be issued soon. The remaining are already issued in one form or the other. Similarly, the forms of business circular is also planned to be finalized quickly. Second, we will endeavor to enhance ease of doing business. A lot of this has been talked about, and the government is also on its part doing its bit, having set up some task forces for enhancing doing of business, both at state as well as at central level. We have already in this regard rationalized a number of our regulations. The number of returns that regulated entities have to submit to us is an example. Now we are in the process, as I mentioned earlier, of consolidating all the regulations, and we have lots of them, thousands of them, into few regulations so that it becomes simpler, easier for you to comprehend and understand. In our pursuit for making principle-based framework, I would like to mention here that we wanted to give autonomy to the boards of the respective entities to frame policies, while the intent was to leave the detailed policy making from the regulator to the banks. What it has done is perhaps that it has overburdened some of the boards of the regulated entities. Therefore, we are trying to rationalize now these macro policies that need to be approved by the boards of the regulated entities and leave the procedural and routine matters with the management under the board, so that the board gets quality time to deliberate on strategic and important matters. This is one concern which has been coming to us, and we will try to address this. Third, we are examining measures to expand bank credit. The BCG report also mentions about it. How can we enhance credit across sectors, sunrise sectors? Mr. Agrawal mentioned about the sunrise sectors, about MSMEs and all other sectors, and so how we can do that so that the needs of our economy can be met by all the regulated entities, banking as well as non-banking, is one constant endeavor of Reserve Bank of India, and we'll continue to move that path. The other one will be as to how we reduce the cost of intermediation. Some figures were presented in the BCG report as to how cost of intermediation has gone up. It's for all of us to understand as to the reasons thereof. I think there are a lot of things happening, and so we need to understand that, a little better. I think the base in 2010 that has been taken, the asset mix perhaps was very different. The size of loans have also now, having the banking industry now shifting towards RAM, that has reduced the loan sizes. The asset quality review perhaps, also has had some impact on this. So we all need to understand as to what can be done in this regard. As announced earlier, we propose to set up a regulatory review cell. It will have the mandate to review all regulations at least once in 5 to 7 years. The objective will be to see if those regulations are still necessary, whether they have become redundant or whether they need any change, whether they are consistent and clear across different regulations, and whether there is any unaddressed or any emerging risk which we need to take care of. The last 3 points that I mentioned, Mr. Sethi already mentioned in his speech, relate to the priorities for our banking industry. And the first one of them is financial inclusion. Economic development is incomplete, we believe, if it is not inclusive. We believe in the adage, if you want to go fast, go alone, but if you want to go far, go together. And so it's very important that all of us take everyone along, and especially those at the bottom of the pyramid. We have made considerable progress in financial inclusion over the years, as witnessed or as reflected by the Financial Inclusion Index, which is constructed by the Reserve Bank of India. Notwithstanding the considerable progress, the FI index points towards scope for further improvement, especially in usage and quality, while also addressing the gaps in access. Let us remember that we have a responsibility to the people, to all the people of our country, and 2/3 of them reside in rural areas. While we have provided banking access to almost all villages since the inception of the Pradhan Mantri Jan Dhan Yojana, within a radius of 5 kilometers, there is still scope to enhance it. I have been mentioning about it, and I reiterate that the business correspondence is a very effective channel for reaching out and providing services in sparsely populated areas of our country. This channel needs to be strengthened. Not only is there a need to augment them, increase the number of the BCs, but there is also a need to train them and to expand the number of services they can provide. I think this will be a win-win, for the banking industry as well as for the customers. On the one hand, this will make the BCs financially viable and sustainable. On the other hand, it will also improve quality and reach of the services. You are all aware that you have launched a program from 1st July to 30th September of reaching out to each of our Gram Panchayats, 270,000 of them in all. I commend you for this initiative, and I urge you all to step up your efforts through these camps for enhancing financial inclusion, including re-KYC, which has now fallen due as the Jan Dhan completes 10 years, and that is the period that has been given for doing a re-KYC. Another area of focus, as mentioned by previous speakers, for the banks has to be MSMEs, which contribute significantly to our employment, exports, and to our GDP. There is a significant credit gap to MSMEs, ULI, and other digital infrastructure can be very useful in this regard. And so I exhort all of you towards further accelerating financial inclusion. Coming to customer service, customers, I mentioned earlier in my MPC statement the other day that they are the raison d'etre, or the reason of our being. Customer centricity is fundamental for sustainable growth of any business. And at the Reserve Bank, we are therefore passionately driven by the objective of customer centricity, key fact statements, and integrating explicit conduct-related aspects in our regulations are some of the examples in this regard. Recently revised guidelines on prepayment charges and draft guidelines on settlement of claims in respect of deceased customers also reflect our customer-first approach. Similarly, regulated entities must focus on excellent and seamless service and experience, creating customer delight. They need to be transparent, fair, and responsive. While digitalization is a key, the human aspect too cannot be neglected, for which training, especially on behavioral aspects, needs to be emphasized. I had on an earlier occasion urged the banks to enable the use of the CKYCR. Again, this was an issue which has been mentioned, issue number 2, something which the government needs to do, but at the same time the banks too have a big role to play. I think the government has already come out with a framework so that the KYC, once done by one regulated entity of any regulator in the financial sector, can be used by the regulated entity of any regulated entity of any financial sector regulator. So this is a great framework that they have brought about for this. The CKYCR is the building block or the master key on which this will reside. I urge all of you to kindly make effective use of the CKYCR. Similarly, I had highlighted the number of grievances escalating at the RBI Ombudsman in one of my earlier interventions. We need all of us, the regulated entities and the RBI together, to put in place an effective grievance redressal mechanism where officers are suitably empowered to take decisions in consumer interest. We on our part are in the process of reviewing 2 frameworks. One, the internal ombudsman framework at the level of the REs to further strengthen as to how you can further strengthen it so that the complaints get resolved effectively within the institution itself. We have had discussions with IBA in this regard. We'll be issuing a draft for consultation and we will look forward to your suggestions. Similarly, the Reserve Bank integrated ombudsman system where the grievances then escalate upwards to the Reserve Bank, that is also being reviewed and we will further strengthen it going forward. The use of technology, that's another very important piece, again came up in the BCG report, so I'm not actually speaking anything new. I think all of you know the importance of financial inclusion, customer centricity, and the use of technology. It is a sine qua non for any business. It is advancing at such a rapid pace at homes, families, workplaces, that no one can actually ignore it. And it has become, the core engine for improving decision-making and customer service, moving far beyond its traditional role of driving efficiency. Again, that was also highlighted in the BCG report. So regulated entities need to accelerate their adoption as they strive to enhance credit and reduce costs. RBI too has adopted technology in all its functions. The account aggregator ecosystem is empowering customers with control over their financial data. Unified lending interface is making credit delivery seamless, making it truly transformative. We will further strengthen these platforms. We have implemented Prabha platform for improving services to regulated entities. We will continue to embrace technology, including AI and ML, and we expect all regulated entities to also invest in them for their benefit and for the benefit of the customers. To conclude, I would like to emphasize that we might seem to be on opposite sides, with the regulated entities trying to accelerate growth and the regulators focusing on stability, but we actually have the same objectives. We are in the same team. We have the same shared vision of a Viksit Bharat. There is no tussle between financial stability and growth. Financial stability and price stability do not inhibit growth. Far from it, they are essential for sustainable growth. I look forward to working together with the regulated entities to improve the efficiency and effectiveness of our financial intermediation to ensure that the due benefits reach the people of our nation. Likewise, on the demand side, I urge the industry and some of the leading lights are present here, to invest boldly and champion the entrepreneurial spirit that defines our nation. At a time when the balance sheets of the banks and the corporates are at their best, they should come together and drive the animal spirits to create an investment cycle which is so important at this juncture. Lastly, in your respective roles, I urge you not to lose sight of the people you are serving. At the cost of being a bit sermonic, I must mention that if there is any doubt in your mind, espouse the philosophies of Gandhi's talisman or Antayodhya. Take decisions keeping in mind how your actions will impact the most vulnerable person in our country. I wish the conference a huge success. Thank you. Namaskar. Jai Hind.